As a new homebuyer, your priority is to find the home of your dreams. But financing is a critical aspect of home buying process for practically everyone. When my wife and I were trying to buy our first home in Connecticut, we were practically overwhelmed by the plethora of financing options that were available. At the same time, I also discovered that not doing your research and just going with whatever recommendation is given by your realtor or broker may not be in your best interest. We did go with conventional mortgage for our first home, but by the time I was ready to buy our next home, I knew all about the FHA and how it was going to serve my interest the best. The best approach is to clearly understand what are the different mortgage options available to a home buyer in the US, and then make an informed choice on what is the best option for your specific situation. We'll discuss the different type of mortgages in this video: conventional loans, government-backed loans like the FHA, VA or the USDA loans, jumbo loans, and finally fixed and adjustable rate loans. So first is conventional loans. As the name suggests, these are the type of loans that majority of Americans sign up for. These are standard home loans that are not insured or guaranteed by the federal government. Instead, these loans are issued by private institutions like banks or credit unions, etc. Conventional loans typically have strict credit requirements as compared to government-backed loans. And since there is no insurance or guarantee provided by the federal government, lender has to take higher risk. If the borrower doesn't pay, lender has to bear all the risk. That's one reason why those criteria are tighter. But there is one benefit to conventional loan. Lender, because lender is making all the decision, the lender has a bit more flexibility on how they want to structure the loan. Government loans, on the other hand, may have very strict requirements. The conventional loans have two different categories. One is conforming, another is non-conforming. Conforming loans are those loans that match the criteria to be eligible to be sold to Freddie Mae or Fannie Mae, these two government-sponsored agencies. So first thing is that these conforming loans may not exceed the limits set by the FHFA. For a one-unit property, which is a single-family home, the FHFA limit in 2024 for most of the US is $766,550. And for high-cost areas, it's about $1.15 million. The second category of conventional loans are non-conforming loans. As the name suggests, they do not conform to the criteria laid out by these government agencies. So they cannot be sold to Freddie or Fannie Mae. One example of non-conforming loans are jumbo loans, which we are going to discuss shortly. So here is a summary of the conventional mortgage loans. The next category is government-based mortgage loans. As the name suggests, the government-backed mortgages are insured or guaranteed by the federal government. Notice that these loans aren't issued by the government. These loans are still issued by the regular lenders like your bank and credit unions. But those lenders are now going to receive insurance from the federal government on these loans. These insurance from one of the government agencies practically assures the lender that the lender is not going to lose money on this loan. So to receive these guarantees from government agencies, the lender has to agree to certain conditions from these government agencies. But in return, the lender is able to offer more favorable terms to the borrowers as dictated by the government and these agencies. Example of these favorable terms would be lower down payment requirements or lower credit score requirements. And why does the government need to back certain mortgages? See, by backing certain mortgages, the government encourages the lenders to give loans to certain borrowers who may not qualify for conventional loan requirements. By doing this, the government is able to expand the home ownership opportunities to a larger population. So which is right for you? Conventional or government-backed loans? Conventional loans are typically good for first-time home buyers whose home costs less than say $500,000, so within the FHFA limit, and if they have good to decent credit scores. And if you're a first-time home buyer, there are conventional loan programs that allows for as low as 3% down payment. I personally use this 3% down payment requirement to buy my first condo in Connecticut. It's interesting, most people believe that you need to save at least 20% for down payment for any home that you buy. That's simply not true. Let me know if you're interested and I can make another video focused on how to determine how much down payment you should put in a house. Government-backed loans, on the other hand, offer some specific flexibilities and geographic options. If you belong to one of those categories which is struggling to qualify for conventional loans, the government-backed loans may be for you. But the interesting thing is, sometimes you may be able to qualify for both, and then you may have to decide that even if you qualify for a conventional loan, maybe the government loan is better for you. So it's important that you clearly understand the eligibility and qualification criteria for these loans and what are their features. So we're going to talk about FHA loans, VA loans, and USDA loans. First, let's discuss the FHA loans. An FHA loan is a type of loan that is very popular with first-time homebuyers. These loans are obviously backed by government agency called Federal Housing Administration, FHA. And because the FHA program protects the lenders from any potential default, the lender is able to offer very attractive terms to the borrower, like lower interest rate, lower down payment, and lower credit requirements. Here are the key qualifications for an FHA loan. Credit score. A credit score of 580 or higher is typically required. But if you have a credit score of between 500 to 579, you may still qualify, but then you need to bring at least 10% down payment. It requires that you did not have any bankruptcy in last 2 years and any foreclosure in last 3 years. On debt to income ratio, it allows up to 43% of debt to income ratio, which is considerably higher, allows you to take much bigger loan. On convention side, typically the lender stops at 35% DTI. It also has some specific property requirements. An FHA approved appraiser must look at your property and approve and appraise it. FHA is only available for your primary home, not an investment property, not a rental or vacation home. And you need to commit to moving into this house within 60 days of closing on the home. So there are some very specific benefits to the FHA loan. Credit requirements are very low. As I discussed, you can qualify practically with 500 credit score. Down payment requirements are low too. You may only need to bring about 3.5% as down payment, and rest 97.5% can be financed through an FHA based loan. Interest rates are very comparable. Even though your credit is much lower, interest rates may be same as that are offered to a good credit borrower for a conventional loan. And sometimes FHA rates are even lower than conventional loans. One good thing about FHA loans is that there is no prepay penalty. You can prepay the loan if you can at any time during the duration of the loan. And FHA allows you to arrange the down payment using different assistance programs that may be available to you. It need not be your own money. So these are some very incredible benefits, particularly for those borrowers who will struggle to qualify for conventional loan. But like everything else in life, there are some strings attached. The first problem with FHA is the mortgage insurance premium, or MIP. All FHA loans requires the homeowners to carry MIP. So for this mortgage insurance, you have to typically pay one upfront payment when the mortgage starts, and then with every monthly payment there will be a component which will be the MIP component. You'll be paying a premium for this insurance every month for the life of the loan. And then there are certain limits on how much FHA will give to you in a loan. You can't have something like a jumbo loan under FHA. It has to be within the limits defined by the FHA. So weigh your pros and cons and see if FHA loan is right for you. For the right borrower who is struggling to get a conventional loan, FHA may just be the right vehicle for homeownership. But if you have served your country and are a veteran, you may have an even better option available in the form of VA loans. VA loans are available obviously only for veterans, but they offer some specific benefits. First is no down payment. This is the only type of loans where qualified veterans can buy a home and get 100% of it financed. That's amazing. In conventional loans, you bring 20% down or at least 3% down. FHA requires you to bring at least 3.5% down. But VA loan, you can actually get that loan for zero down. Can't get better than that. Of course, you should know that if you are taking 100% loan on a house, when you add up other costs like closing costs, etc., you probably start with a house which is valued less than the amount of mortgage that you owe on the house. So that's a risk, but it's an option. Also, VA loans do not require the private mortgage insurance, PMI, which we just spoke about under FHA. So while FHA will force you to pay for a private mortgage insurance, VA loans won't. And avoiding this PMI on the life of the loan can save a veteran thousands as compared to, say, a conventional loan or an FHA loan. Like FHA, the VA loans also allow for higher debt to income ratios, DTI. And like I said earlier, the higher DTI ratio, like in case of VA loans, it can be 41%. Higher DTI ratio means you can take higher debt as a percentage of the income. You can afford bigger houses than what a conventional loan will allow you. Similar to FHA loans, VA loans also have no prepayment penalty, and they offer competitive rates like conventional loans or FHA loans. And VA loans also offer a lot of credit flexibility. Even if your credit score is low, you may qualify for a VA loan. Another unique benefit to VA loans is that they allow you to refinance your property without even requiring a new appraisal. There are a lot of benefits that have been provided to veterans who rightly deserve those. So if you're a veteran, you must look into the VA loan. loans. But if you're not a veteran, is there anything else left for you? Probably yes. You must check out the USDA loans. These are also known as Rural Development Loans. These mortgages are backed by US Department of Agriculture and have been designed to support low-income borrowers in designated rural areas achieve their dreams of homeownership. If you qualify for USDA loan, like VA loans, USDA does not require any down payment. Again, this can be a significant advantage for those homeowners who cannot afford to save big money for a down payment. USDA loans also offer very competitive interest rates. In fact, they typically have the lowest interest rates among all category of loans. They also have flexible credit requirements, so lower credit is generally acceptable. They do not have any prepayment penalty like the FHA and VA loans. So how do you qualify for USDA loans? First is an income requirement. Because these loans are aimed for low to medium income families, there are specific requirements for income. Typically, they are available to those whose median income or whose income rather is lower than the median income in that area. It differs from area to area, so you should refer to the USDA website for what kind of income is the limit in your areas. Property location. This is very important. To qualify for a USDA loan, your property must be in a designated rural area. So the USDA website provides a map where you can see if your area comes under the designated rural area for USDA loans. One simple guideline is that if you are in a major city or a metro area that's generally outside the USDA rural area designation, except that pretty much the entire country is covered. But do check out that map. And like FHA, the USDA loans are also for primary occupancy. So they expect you to occupy this house as your primary residence. They're not available for investment properties. For all of these loans, the value of the property needs to be within the guidelines set by government agencies. I hope you remember those what we discussed earlier. And mind it, this is true even for conventional loans that are not backed by government. But does that mean that there is no hope for those who want to buy properties whose values are higher than the limits set by government agencies? Well, there is. Let's talk about jumbo loans. A jumbo loan is a type of mortgage that exceeds the limits set by FHFA. These loans cannot be purchased, guaranteed, or securitized by agencies like Freddie Mae and Freddie Mac. Jumbo loans are meant to finance those expensive properties that do not conform to the regulatory limits for that locality. These jumbo loans are considered riskier for the lenders because they are not going to be purchased by Freddie Mae or Freddie Mac, not guaranteed by any government agencies. So if the borrower defaults, the lender is at a higher risk. Since these loans cannot be sold to anybody, they typically remain on lenders' books, and hence they are also called portfolio loans because they are part of lender's portfolio. There are some specific requirements. Jumbo loans will typically require higher down payments. The down payments will typically start from 10%, but depending on the lender and your credit history, credit profile, these requirements of down payments can go to 20% or even higher. And lenders do very strict underwriting for jumbo loans because they have higher risk, they want to limit that risk. But if you're hoping to buy a big luxurious home, a jumbo loan might be what the doctor ordered for you. Before we end, let's quickly touch upon the two types of loans available to you based on the interest rate type. First is fixed rate mortgage. Here interest rates, as the name suggests, remain constant through the entire length of the mortgage. If it's a 30-year mortgage, the interest rate will remain same for the full 30 years. So you get very predictable monthly payments, and these are ideal if you're buying a house and planning to stay in it for long term. On the other hand, the second category is ARMs or adjustable rate mortgages. Here typically the interest rates are fixed for a short period in the beginning for a few years, and then they become variable. So after the fixed period expires, the rates adjust periodically. These are ideal only for short-term situations where you need the loan for some time and then you know you are going to either refinance or sell the property. And these are more common in unconventional scenarios, not for regular home buyers. Remember, each type of mortgage has its pros and cons. It's essential to choose that aligns with your own specific scenarios and circumstances. I hope this discussion helped in making you aware of all the different options available to you. If you found this information helpful, give us a thumbs up and consider subscribing to this channel. You may also want to check out this other video. Don't forget to share your thoughts. We love hearing your perspectives. Thank you.